Steve?
Thank you, Kelly. The Fed's Beige Book says the economy continues to expand with varying conditions across industries and across districts. Now, most districts reported slight or modest growth, so not really any barn burners being reported out there. Retail spending was flat to slightly up. Discretionary spending was said to be mostly lower, with heightened price sensitivity among consumers. That's a theme throughout this Beige Book. Manufacturing was flat to up. Tight credit standards and higher interest rates were constraining lending growth. Housing demand, however, rose modestly. Overall, the outlook was somewhat more pessimistic than the prior Beige Book. Unemployment, it was rising at a slight pace. 8 districts said they negligible to just modest gains, and 4 saw no change in employment, but there was better labor availability. And along with that, wage growth was mostly moderate. Now, several districts did see wage growth moderating and coming back to sort of normal or pre-pandemic levels. On prices, consumers were pushing back against new price increases, but profit margins were under pressure because input costs continued to increase. Overall, price growth was expected to continue at a modest pace. So, guys, kind of a lukewarm Beige Book here, not so great on growth. A little bit interesting that you have this price pressure on the input side, but an inability of companies to raise prices on the consumer side.
Does this all add up? We're going to bring Keith Fitzgerald back into the discussion. So, Keith, listen, because I might ask you the similar question. But, Steve, let me begin with you. Does the fact that the Fed saw discretionary spending slowing, price sensitivity increasing, and moderate wage growth tell you anything about where inflation should be expected to be in the reports that will come up over the next couple of weeks?
I mean, I think overall what they're describing is the contours of the dynamic the Fed is looking for, which is a slowdown in the economy that helps bring a slowdown in both wage growth and a slowdown in price growth. And I think this dynamic here, which I'm listening for, Tyler, in the earnings reports, in our interviews with executives, of consumers pushing back. Then you have this margin issue and what companies do with their margins. Do they eat it a little bit on the margins, and do they push back on the input costs? Does it start, let's just say that the stone rolling downhill rather than the way it's been going uphill when it comes to prices, that, hey, guys, pushing back from the consumer to the producer to the supplier of raw materials that, hey, these price increases won't stand. This, I think, is along the contours of what the Fed is looking for.
So, Keith, we had a guest on yesterday who I guess, framed the Fed's issue or the economy's issue this way. Which will crack first, inflation or the economy? Is that an oversimplified way to look at things?
No, I don't think so. I think it's spot on. And I love how Steve summarized this. I think the pressure that he's driving at and highlighting is at stake here. I think there's actually a third element to what your guest should have mentioned, and that is that the Fed has a fiscal problem, because as long as it's looking in the rearview mirror, it can't be looking down the road. So it's not a matter of which cracks first in my mind. It's a question of how you play your cards. You know, again, not all companies are the same, and they're going to be able to protect margins differently. Manufacturing, not so much. Tech, all kinds of protection, particularly if it's a must-have product.